Welcome to the latest episode of Quest for Twice. In this episode, I'm excited to do a deep dive on a new company that I think offers a very attractive risk versus award considerations. So the company is Walker and Dunlop. This is a financial service company in the commercial real estate industry. So how does it make money? It does multifamily loan origination and brokerage. So the loan origination is really just a way of saying that it provides a mortgage to multifamily, i.e., apartment owners. And the reason it's different from a bank is that it doesn't really hold those loans for a long time. It's making loans on behalf of government-sponsored enterprise, for example, Fannie Mae, Freddie Mac, and HUD. It also broker loans. In that case, it doesn't really own the loans, even on a temporary basis. It just match the borrower with the lender. Usually, those are private parties. For example, insurance companies. It also originate other types of commercial real estate loans, for example, shopping centers and broker those type of loans. Another way it makes money is by service mortgages. For example, Fannie Mae or Freddie Mac may own some mortgages, but they don't directly deal with the borrowers. For example, I may have a mortgage on my house and I need to make a monthly payment, but I don't get invoices from Fannie or Freddie, even though they own my mortgage. Instead, I will get a bill from a mortgage servicer and send my payment to those servicers. Another way Walker and Dunlop make money is by broker property sales. This is similar as the residential uh, sales agent, but for this case, Walker and Dunlop as the sales broker and an agent for commercial properties. Finally, it also acts as an investment banker and fund manager. So, if someone wants to invest in a commercial real estate, then it can buy a share of the mutual fund run by Walker and Dunlop. And Walker Dunlop will pull the money together, then invest in commercial real estate and charge a fee for managing the investment. So Walker and Dunlop has multiple ways to make money. Because Walker and Dunlop is mostly a financial service company. So it's a little bit difficult to understand its business model and balance sheet and loss and income statement. So let's do a bit background introduction. So let me introduce some context. So what is an asset? For an industrial company, it's very straightforward. Its assets are its plants and the equipment. So they will output goods. And then the companies will sell the goods to generate cash flow and revenue. For a financial company, what is an asset? So the financial assets actually are loans and equities. Why? Because when a company owns a loan, that means the borrower will pay interest to the owner of the loan, i.e. the asset. So the asset will generate the interest income and the dividend. With that context in mind, let's look at the assets of Walker and Dunlop at different points of time in the past. So this table listed the various types of assets of Walker Dunlop, and I highlighted the ones in blue about the income producing assets. For example, the pledged securities, they may earn dividend, and loans held for sales, they produce interest income, similar as loans held for investment. And lastly is mortgage service rights. They also produce income. I'm going to get into that conversation a bit later. But just keep in mind that that's a type of income producing asset. So if we look at the loans held for sales and for investment for the past several points of time, we see that the values change very drastically from one period to another period. The main reason is that Walker Dunlop doesn't really own those loans on long-term basis. So they originate the loans to borrowers. Then after several months, then they will sell the loans mostly to the government-sponsored enterprise, the GSE. Sometimes also sell the loans to private investors. So as a result, at a given point of time, the loans they held on their book can be very different. Depends on how much they have carried versus how much they have sold off. However, the mortgage service rights is a long-term asset they own, and the higher the better, because that produce steady income when they service the mortgages. So we can see that for Walker & Dunlop, and the MSR has been going up steadily from end of 2019 to end of 2020, then to end of the first half of 2021. So the best way to think of Walker & Dunlop's business model is think of it as providing a platform. On its platform, the borrowers and the lenders are matched and make a transaction. So the lender will lend money to the borrower. So that's a transaction. And Walker Dunlop makes money by getting a cut of the transaction it facilitates. And also, oftentimes, Walker Dunlop retains the right to service the multi-family mortgages, even if it doesn't own the mortgages. So that becomes a long-term asset, will produce a steady income over the future years. So the best metric to look at the health of W&D Financial is to look at the transaction volume. So this bar chart shows the transaction volume growth in the last 12 years. The compound annual growth rate was 34%. That's very impressive. So this bar chart ends at 2020 for $41 billion. And in the first half of this year, the transaction volume was 22.6 billion. So it's more than half of 2020 volume. And 2020 volume was significantly higher than previous years. So that's basically a pandemic-driven abnormally. And so 2021 will go back to kind of a normal growth. If we put in the long-term context, it's still maintaining the very healthy annual growth rate. Now, let's have a deep dive into the mortgage service right, MSR, as an asset. The reason it is an asset is that when WD service a mortgage, it earns a income. So the service fee is roughly 0.24% of the loan balance. And the future service fee is secured when a loan is added to its servicing portfolio. So in this chart, the bars at the servicing portfolio, we see that it had a steady increase from 2015 to 2020. And on June 30th of 2021, its service portfolio stands at $114 billion. Then if we multiply that by the service fee as a percentage of the loan, we get this black line that shows the service fee increase annually, and reached about $236 million in 2020. So that this is a very valuable asset. Another interesting thing to note is that from accounting point of view, when a service right is obtained by WD, its asset value increased as MSR. Then this value increase is recognized as a revenue. So although the mortgage service fees will be realized in the future, but it's actually discounted to the present value, and that increase is recognized as a revenue. As a result, that's actually a non-cash revenue because the cash payment for the service fee will be in the future. So that's something very important to understand when we look at the revenue and the expense part of the financial report. WD also has been working on a new growth area, that is the property sales. So it takes a commission when it brokers a sale, just like the residential housing market. It's a property sale and the property financing business segments are very synergistic. The reason being that when a property may be refinanced, the owner may actually choose to sell the property. So then the financing team may get valuable leads about the upcoming sales. And vice versa, when a property is sold, for example, by a WD agent, then the buyers will inevitably require financing, and then that brings a business to the financing arm of WD. So we see that WD property sales volume has been rapidly increasing in the last 6-7 years, and with the annual compounding rate of 32%. So in the first half of 2021, its sales was 4.7 billion, compared to the whole year transaction volume of $6 billion. So it's a growth story about the property sales is also on track. Now we are ready to look at the revenue picture of WD. So this table shows its revenue breakdown by segment in the last 3 years, as well as the first half of this year. So the loan origination and debt brokerage fee has been increasing in the last 3 years, especially a big jump in 2020 from 2019. And then in the first half of 2021, it's on pace to reach the amount from 2020, but now as a rapidly growth as from 2019, which is understandable given the pandemic induced rapid growth for loan originations and the debt brokerage fee. Its fair value of MSR revenue, as I mentioned earlier, that's a non-cash revenue in the first half of 2021 is actually less than half of 2020. And the 2020, again, was a very significant increase from the previous years. That's because the MSR mostly is derived from the government-sponsored enterprise like Fannie and Freddie. And during the during the pandemic-induced recession, Freddie and Fannie really stepped up and provided a lot of liquidity to the market. As a result, a large amount of multifamily financing was through the GSE compared to private parties in last year. And those financing has traditionally generated a large amount of mortgage service rights for WD. And now this year it's reverting back to normal. So if we look at the MSR revenue in the first half of this year is more than half of 2019 MSR revenue. So I would say this is reverting to normal for WD. Its servicing fees has been increasing, and that's because of the driver of increasing the MSR as a asset. So that has been the MSR asset has been steadily increasing, and that's reflected in the steady increase of servicing fees. I just covered about the property sales transaction volume in the last several years. So its transaction volume was very small or negligible in 2019 and 2018. Now, in the first half of 2021, its revenue and has exceeded the total revenue from 2020 because of its very rapid growth of property sales transaction volumes. Its interest income has declined significantly because of the interest rate environment, which is okay because that's not a significant revenue component. And its other revenue in 2020, in the first half of 2021, is relatively small compared to the previous years. The main reason is that in the 2020 number is misleading because the $83 million actually includes the property sales commission of at least $26 million. And so there is a double dipping there. Now in the 2021, WD has separated the property sales commission from the other revenue. So if we want to do a apple-to-apple comparison, we need to add the property sales commission, $31.5 million from 2021 to the other revenue of $23 million in the same period. Then times 2 to compare with the total other revenue in 2020, that is $83 million. So this is really, at this point, I would say not a significant consideration. As I mentioned repetitively, the incremental net present value of a future servicing fee is treated as a revenue in the current year. So this can be very confusing and also introduces some quirks when I analyze the financial picture of a WND. Another side of this coin is that the MSR is also amortized each year, so that's treated as an expense, which I will look at next. As I mentioned earlier, WND's MSR revenue in the first half of 2021 was below trend compared to its MSR revenues in the past. The main reason was because of the GSE was not active in the first half of 2021, and WND derives most of the MSR revenue from GSE mortgages. So this chart shows the WND loan value delivered to GSE in the past, and the year-to-date in 2021 was significantly less than previous years. However, if we look at the line chart, that is the WND's market share of GSE loans. Its market share held steady at 11%. That's about the average in the past. So it's so WND did not lose any market share in 2021 so far, and GSE has a large funding capacity left in 2021, and is expected to be active in the second half of this year. So hopefully, WND will retain its market share with the GSE in the remainder of 2021, and GSE will be active. Then the WND's MSR revenue will strongly recover, and at least that's a reasonable expectation. One interesting thing to note is that before 2017, the WND's market share with the GSE was between 10.6% and 11.3%. And the loan delivered increased steadily from 2013 to 2016. Since its market share didn't change that much, then the conclusion is that the GSE was becoming more and more active from 2013 to 2017. Then it just held steady after 2017. So it's interesting to note that the WND's revenue is quite correlated with how GSE behave. So I would consider that as a risk, because the GSE may or may not be so active in the future and stay so engaged in the multifamily lending market. Now let's take a look at the expenses. The biggest expense for WND is its personnel. So that's usually 41 to 43% of its revenue. The exception is in the first half of 2021, the personnel expense was actually 47%. That's because of the lower contribution from MSR revenue, as I discussed earlier. The personnel expense mostly wages and commissions and the bonuses. When an agent successfully made a loan origination or brokerage or a property sales, then the agent is paid a commission based on the value of the transaction. So that's why personnel expense has been the largest component of the total expense. The next line is amortization and depreciation. The largest contribution to that is amortization of MSR, because MSR was treated as an asset, so each year it depreciates, and then the depreciation cost is going under the expense. The third one is a provision for credit losses. So 2020 expense of $37.5 million provision was a reflection of the market downturn and the great fear that there will be a very prolonged economic hardship. It actually didn't materialize. So in 2021, the provision for credit losses were actually negative. That means the funds were released from the provision, and it reduces the expenses because that's a negative value. So putting together, the 2021 first half expense is a little less than half of the 2020 expense, and that's helped by the provision for credit losses release I mentioned earlier. Because of the revenue increase in first half of 2021 was not as strong as the past. So the income from first half, $147.5 million, is significantly less than the half of 2020 operating income. And as a result, the operating margin is 29% compared to 30% in 2020. I'm not really too concerned about this, mostly because of the quirk related to the MSR revenue I mentioned earlier. And also, its personnel expense has been going up annually in the past. I'm okay with it because employee brokers are actually considered assets in my calculation, because they generate future revenues through transactions. And WD hopefully it has been hiring very good brokers, and if they stay employed for a long time with WD, they will the initial increase in personnel expense will be paid off through future, hopefully recurring revenues generated from the transactions. Because MSR revenue and amortization are not cash revenue or cash expense, so we need to take a look at the financial picture of WD from a cash perspective. And here the EBITDA is used as a cash proxy with the MSR impact removed. And this graph shows the annual EBITDA for WD. What we see is the 2020 EBITDA was about $32 million less than 2019. That's mostly caused by additional $122 million personnel expense increase from 2019 to 2020. I feel okay with that because, as I mentioned earlier, I consider the personnel as a capital investment, although it shows up as an expense. And WD has been hiring people, and that's a way to drive future revenue and earning growth. So I'm okay with that. And the WD has delivered about a 12% annual growth rate in EBITDA, which is a cash proxy. So it's a very healthy cash generation. And so we need to put the cash generation in the context of cash outlay. So in 2020, WD bought back stocks for $26 million and paid dividend for $45 million. And he also paid income tax for $84 million in 2020 and spent $47 million for merger and acquisition in 2020. So if we add the cash outlay from 2020 together, that's about $200 million. And that's still less than the 2020 reduced EBITDA, which has, as I mentioned, is considered abnormally from its long-term growth trend. That's why I think WD is in a very strong financial position, generating plenty of cash for buyback, dividend, as well as investing in future growth in terms of M&A, as well as hiring additional people. Its corporate debt stands at $292 million. So its enterprise value over 2020 EBITDA was about 16 at $100 per share. And if we use 2019 EBITDA, the ratio becomes 14. In the first half of 2021, it generated $127 million of EBITDA. So that's on track to exceed the EBITDA from 2019. Now, let me summarize the investment thesis and risks. So I consider the WD as a high growth company that is undervalued. If we look at its earning per share since 2015, it grew its earning per share by about 24% annually. One can argue the 2020 earning per share was artificially high because of the large impact from MSR revenue. Even with that, I still consider 2021 the earning per share will be reverting to the historical trend of growth. So I consider WD as a high growth company. And now let's look at its valuation. Its price over sale ratio is 2.9 and EV over EBITDA is about 14. And the price earning ratio is about 12.6. So we need to put that in context with other financial firms. The 5-year average price over sales and the price over earning is 3.4 and 13.4 for JP Morgan Chase, which is considered the best of the major banks. And those ratios are higher than WD. And for M&T Bank, that's a regional bank, the price over sales ratio is 3.8 and PE is 15.2. That's even higher for a smaller regional bank. So that's why I consider WND as undervalued. Another way to look at it is EV over EBITDA ratio of 14 using 2019 EBITDA. 14 is a fair valuation ratio if there is a very little future growth. However, we know that since the EBITDA doesn't consider the MSR contribution and WND generated a lot of MSR revenue in 2020, so its future cash flow or EBITDA will increase even if WND doesn't generate as much of MSR revenue in 2021 and beyond. As a result, the ratio 14 for EV over EBITDA to me is a undervalue of what WND will generate in the future. And in addition, WND has outlined its growth strategy to 2025. That's mostly from commercial real estate financing, especially related to the small balance loans, since WND has been focusing on large loans in the past. So that will be a potential growth driver. And I also outlined earlier about its property sales growth has been growing very rapidly. So those growth drivers will likely maintain the momentum for the earning per share growth WND has enjoyed in the past. So what are the investment risks? I would say a major one is 50% of WND transactions are GSE related. So that's a revenue concentration risk. And if there is any major change to the GSE's incentives and motivations or constraints, then WND will suffer. And also, 90% of transactions are from multifamily market, so that's another concentration. As we know, currently the residential housing market is very hot, and so the apartment market is lagging behind, but the rent has started to increase. The thinking is that the U.S. has been under constructing housing units in the past from single family as well as multi-family constructions. So hopefully there will be some tailwind in the future. Of course, it's difficult to forecast the future. But I would say this concentration risk is something to watch for, but it's not like there is a clear headwind ahead. The third risk is that if a loan WND handle the defaults, the WND may share the loss even if the loan has been sold or passed on to other entities. So that's why it's important to understand the quality of the loans WND originated. We can use its provision for credit losses from the past to understand the quality of its lending practice. So we can see that before 2020, the provision for credit loss was most in 2019 for $7 million. And before that, the amount was less than $1 million. So I would consider WND's lending practice is of a high quality. So this default credit risk to WND is relatively small, considering its historical growth trend and current valuation level, I feel fairly comfortable of having a relatively large position in WND. So this concludes the latest episode of Quest for Twice. Thanks for watching. Until next time, happy investing.